Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we were showing you a little chart there at the end of the, just before the break, and this chart was showing, it's an indicator. So we'll take a look again at this. Margin debt is a bear market indicator. There's two parts to this. One of them is the part that talks about the forecast, and this has been a pretty accurate forecast over 3-year returns. But there are two parts to it. One is margin debt related to GDP. The other is the 12-month moving average of that. So when we're looking here at the 12-month moving average, this is the other end of that. Both these indicators very strongly showing that we, over the next 2 to 3 years, a drop of somewhere in the neighborhood of 35% or more in the stock market. All right, now this is just one indicator. These things aren't again, crystal balls, but here's the part. We can go ahead and get rid of that side. Here's something to think about when it comes to how these indicators work. Much like what we're looking at when we look at the cycles in the market and we see some of the things, we know the Federal Reserve policies have been propping up the markets. We see that, proof of that, in fact, when we look at what happened in December when we had just a 25 basis point increase in Federal Reserve rate. I mean, you're only talking 0.25% in the market swoon. So here's the thing. Well, and now part of that was that the Federal Reserve not only that increase of 25 basis points, but at the same time said that they were going to continue to do 25 basis point increases, most likely over 2016 every quarter. Well, of course, that didn't happen because determined that it was not the right time to be doing it. All right, now they're back to, again, hey, we need to do something about raising these interest rates and getting back to letting interest rates normalized, if you will. So this is one of the problems that we're running into. We've got this artificial propping up of money. We've got, when you look at the stock market as well, the overvaluation, you've got companies that we're seeing a trend here where their profits may have, showing strong growth, but revenue not so much. And this is an indicator, again, that we're not seeing true growth, and that's where the real issues come in. You can cut costs, you can have cheap money, you can do a lot of different things to help make your bottom line look better. But if you're not growing as a company, if you're not, having increased revenue to increase profits in the future, there's only so much you can cut. Just think of your own household budget. Two things that we look at, and this is important when it comes to retirement planning, right? One is the things that we can control, and those are income and expenses. These are the two areas that we look at. Of course, assets and liabilities, but let's think of how those things work. So first off, on income, we can control that a little bit. Now, depending on your job as to what kind of control, or if you want to take on extra hours if you're able to, or if you, for that matter, even a side job, or however that works in your household, you can somewhat have a little bit of input with regard to what happens with your income. For some people, more input than others as to what that might be. All right, the other is expenses. This is one we can all do. All right, we can all cut our expenses if we want to. We can, reduce down expenses in terms of, percentage of, and that can help us then retain more of our money. Take more of that money then goes into assets, right? And we can grow our assets from that. If we have the opposite occurring, if our expenses are going up relative to income, in fact, we may be borrowing money and creating liabilities against, and this is particularly important as we get nearer to retirement, of course, that we want to ideally eliminate those liabilities, increase our assets. Our income is about to go into a fixed income type state with regard to Social Security, a pension, or whatever it might be, and that as that earnings income goes away. So these are some things to consider when we're looking at preparing for retirement, of course, and for that matter, these are good no matter how. The earlier you start in doing these, in developing these good habits, the better. Well, this also applies to companies, okay? If you think about it, same concept. They can cut expenses and therefore increase their profit margins in doing so. But unless they've got increased income, there's only so much there that's going to be, it's going to cap out at some point, if you will. There's going to be a bottom line where you can't cut expenses anymore. And unless you're increasing your revenue, then that's going to cap out your earnings, and that's where things get a little dicey, okay? Now, the other part is if they're taking on assets or liabilities, increasing, and that's where, again, income growth, you can increase the assets in the company, and that can help you look better for the future, give you more security, if you will, and riding out rough times if you've got more capital available to you. All right, so here's where we're at. We're seeing this in the companies. Not so much do they have now. They're capping out at these areas right now without that increased revenue. How does that get fixed? Well, a lot of it's going to be regulatory type things. It's going to be, again, reducing the corporate tax rate. There's going to be some things in Washington that are going to have to occur for us to get our economy back in order. The market itself, or the companies themselves, the corporations, that only can do so much. So reducing regulations, this is going to, because we're closing down industries right now prematurely, I would say, and that's going to have a ripple effect out into the economy. One such example I've talked about is the coal industry. All right, now there are those that say, well, we want, cleaner energy and all that, and that's good, but we're not there yet. Okay, so one of the problems we're having, we're eliminating jobs, some very good paying jobs. We're talking about, I think I'd heard these were, coal mining jobs in the $80,000 a year range. That's a pretty strong, good job, right? Especially when you look at the average income in America being somewhere around $50,000. So here's an industry that's being decimated, and the ripple effect of that. Okay, there are other companies, other businesses that support the coal industry that are also then having to cut back. And then not to mention, in all those areas where they have that industry, all the small business owners that basically supported that, lived off the revenue that came out of that as well. All right, could be anything from restaurants and dry cleaners and grocery stores and you name it. Okay, all the shops and clothing and shoes and all those things. If people have less money, right, that puts pressure on them. And in many instances, you see those companies go out of business. You can go into an area, which we've seen in the past, where we see, for instance, a military base gets shut down, and all of a sudden it becomes like a little ghost town around it, as all those small business owners that were dependent on that could no longer stay in business. So all of these ripple effects we haven't even felt yet, just how bad that could be. But here's some things to understand then, and all this comes back again to the stock market. Why we need growth, why we need a lower corporate rate to allow more money, all right, lower corporate taxes to allow small businesses to in fact grow, to add people, more jobs, more people paying taxes. It kind of takes care of everything when you take care of that job thing. How does this relate then to the stocks and that? If this is, and the election, and that's where I was coming around to. This is a concern about the election. What impact is it going to have on your investments? And this is a good time for you to be looking at your investments, because do you understand how it may affect you? All right, so if the stock market were all of a sudden to drop by 35%, okay, as they've talked about over the course of the next year or 2 years, how are you positioned for that? Are you positioned at least as well as the S&P 500 index? Because remember what we've talked about before. S&P 500 index, right? 500 biggest companies in the United States. That index outperforms 80 to 90%, depending on, in fact, if you listen to Tony Robbins, his research showed it was over 90% of equity mutual funds out there. So if you're mutual funds, do you know, are you actively invested or are you passively invested? Do you know the difference? Do you know what your costs of investing are? Do you know how much you're paying for what you have with regard to the fees and everything in it? Do you have variable annuities? Do you understand the fees and the costs that are inherent in those, and what the risks are, again, in relation to a bear market? These are important things for you to understand. If you don't know that now about your portfolio, if you're just trusting that this person who's helping you knows, you might want to check on that, all right? First off, many of the advisors out there, they're getting their information from someone, from their boss maybe, and that boss from their boss, and so on. So this is being passed down, but is it, from in a broker-dealer situation, for instance, based on the research that they're providing you, they're saying here are the things to show. Are they in fact knowing or understanding what you have? Because if they don't, and you're trusting them to know that stuff, that puts you at tremendous risk. Understanding what the risk is in your portfolio. So if we go through a 35% bear market as an example, or let's look at 2000 to 2002 as an example. So if I had an S&P 500 index fund, okay, mutual fund that I can go out and buy many of them, right? Vanguard, T. Rowe Price, number of companies, Fidelity, and there's so many of them, right? These are S&P 500 index mutual funds. Now I could go out and put my money in that, all right, and I know over the long term that's going to do quite well. Over the last 40 years, as an example, if I use that as a term, it's been over 10%, okay, as an average return. But I had a tremendous amount of standard deviation of 18%, which means that's a lot of volatility, a lot of ups and downs, all right, to get that 10%. Now, if I can compress that volatility range down to about half that, say about a 10% standard deviation, and still get that 10% average rate of return over the same period, you can see that that could be very beneficial. May give you a lot of peace of mind anyway, right? Well, that is very possible. Here's the other part of that. If you've got the S&P, as I said, you've got the volatility, you've got those returns, it's outperforming most mutual funds. That means if you have mutual funds that are underperforming the S&P 500 index on average, then you're not going to do that well. That means in that bear market, when it dropped 44, your portfolio would have dropped even more. And it took it 5 years to recover. Your portfolio would take even longer. So this is a good time to take a close look at that, because there are portfolios that have, by design, weathered that extremely well, and as I said, recovered almost immediately, and that would be a lot easier on you, right? Especially, and this is the other part, when you're heading into retirement, the effect that that's going to have as you may be taking income from those, that's where it becomes critical. It's probably one of the biggest risks out there, called return risk, and I'll get into that. We're going to take a break. When we come back, I'll talk about some of these risks and how you can protect yourself, how you can invest properly in the market, and how this is a great time to do a quick analytic of your own portfolio. So join me here. We'll be right back on the Retirement Report.